This number to cool us and bring us to parity. And here we go. Let's start out with Empire, shall we? Empire expected to be down 10 is down 15.6. Down 15.6, the weakest read since January. Now let's go to CPI, shall we? These are the April reads, of course. Headline up 0.3, a little cooler than the rearview mirror, which was up 0.4. I haven't seen revisions. They were late yesterday in coming. If we look at the ex-food and energy, also up 0.3, and last month that was also up 0.4. So that definitely cooling off as expected on that. Now, let's look at the year-over-year numbers, probably the most important. 3.4 is the year-over-year headline, and that is 1/10 cooler than the rearview mirror, equal to expectations, and that is the lowest year-over-year since we're at, well, 3.2 in February. See, last month was the pop. And if we look at CPI, ex-food and energy year-over-year, this is 3.6. That is definitely cooler than the 3.8 we had last time. And the 3.8 last time, and along with the 3.6 this time, is now the lowest level of year-over-year core inflation since April of 21. So these numbers are close to expectations in every way, and actually sequentially a bit better than last month, which spiked. You see yields moving down. Now, we're not done with the data yet. I like to look at the CPI index because I think the CPI index is very important to look at. 313.54 is the non-seasonally adjusted, and guess what? That's a new all-time high. And if we look at the core at 317.62, that's also a new all-time high. So here's what we really see. The politicians are going to say, wow, it's a bit cooler than expected. And in many ways, they're correct. But it's still on the indexes, both seasonally adjusted, non-seasonally adjusted, the highest ever since record keeping, the index that we figure all this on. Now, we're not done now. We have retail sales as well. Retail sales for April. Let's look at the headline number. It's unchanged. Unchanged, that's a bit of a miss. We're expecting a number closer to up 0.5%. Rearview mirror up 0.7. Last month was a very good reading. It now moves to down 0.6. But remember, February was up 1%. So there was a bit of a give back, many people thought. But if you really look at it, this is a disappointment because it loses some of that momentum we were talking about with the consumer. Now, if you strip out autos, the number improves. So you can see autos was a bit of a drag on that, up 0.2 exactly as expected. In the rearview mirror, that very strong 1.1 downgraded to up 0.9. Strip out autos and gas, it deteriorates. So you can see the effect of removing both of those. Now it's down 0.1%. Down 0.1% is the second weakest of the year. The weakest month was January at down 0.8. And finally, the control group is down 0.3. That's inputted into higher up the food chain economic data like GDP. Down 0.3 is the second weakest since January when it was down 0.4. The disappointment, of course, is that we didn't hold some of the momentum. But to be fair, last month's 1.1, still a juicy 1%, downgraded by 0.1. Now, how do we synthesize all of that? Let the markets do it. We see that we're moving down to 4.35 in a 10-year. The low yield is around 4.33. And 4.32, 4.33, big support. When we slipped under that 4.70, this is where most technicians thought we would hold. So pay attention to this level in 10s. Pre-opening equities are loving this number. They're up almost 200 points. And my guess is, Joe, that you're going to pay close attention to that foreign exchange relative value trade there between the euro and the dollar as our inflation cools and the markets, they may be rallying for other reasons in addition. But this is going to go a long way because a Fed easing, well, hey, interest rates cause lots of pain in lots of industries.